Debt. You might think that debt is something to avoid or pay off as soon as possible, but not for billionaires. They use debt to buy, borrow, and die. What does that mean? Well, get ready. We're going to talk about it in today's video. Hi there, and welcome to Fun Financial Insights. And on this channel, we talk about everything related to money, from personal finance to investing, in a way that's engaging, informative, and entertaining. Today, we're going to talk about how billionaires use debt to make money. Yes, you heard me right. Debt. The thing that keeps us up at night and stresses us out. The thing that we think about as bad. Could be good. Well, not exactly. Debt is one of the main tools that billionaires use to stay rich and get richer. How do they do that? How do they use debt to make money and avoid paying taxes? And how can you learn from their strategies and apply them to your own financial situation? Well, let's get started. Before we dive into the specific strategies that billionaires use to leverage debt, we need to understand the differences between good debt and bad debt. When you borrow money to purchase an asset that is expected to create greater income than the debt servicing cost, that is good debt. This type of borrowing may potentially lead to greater wealth creation. On the other hand, bad debt is when you borrow money to make purchases that do not generate any additional income or value over any time period, and the interest must be paid back from other sources of income. You can think of that as spending borrowed money on liabilities. Let me break this down even further through examples. Mortgage loans. Sometimes people borrow money to buy a home or a rental property. You see, the property itself is an asset that can appreciate in value over time. And if it's a rental property, it can also generate income from rent payments. This kind of debt is called a mortgage loan, and it's a good debt. Why? Well, this is because as long as the rental income covers the mortgage payments and the property expenses, you are essentially getting paid to own the property. And if you sell the property later, you can potentially make a profit from the capital gain. Now, in contrast, let's look at credit cards. Credit cards have very high interest rates, usually around 20% or more, which means that if you carry a balance, you are paying a lot of money in interest every month. When you use your credit card to buy things that you don't need or can't afford, and then you don't pay off the balances in full every month, the longer you carry the balance, the more interest you pay, and the harder it becomes to pay off the debt. Guess what type of debt this is? Yes, that's right. This is bad debt. The credit card debt, in this case, does not generate any income or value for you. It only drains your money and reduces your net worth. Now that you have a basic understanding of good and bad debt, let's look at some ways that billionaires use debt to make money. Now, don't worry, these are lessons that you can adapt and apply regardless of your financial status. But before we go on, if you're not subscribed to this channel, please hit that subscribe button so that you don't miss out on any of the fun financial insights that are coming every week. So, how do the wealthy use debt to build wealth? Well, number one is leveraged buyouts. In 2013, Michael Dell, the founder and CEO of Dell, the computer company, teamed up with a private equity firm called Silver Lake Partners to take Dell private in a $24.9 billion deal. They used $1.4 billion of their own money and borrowed the rest from banks and investors. They also used Dell's assets and cash flow to secure and service the debt. Fast forward to 2018, and Dell announced that it would go public again through a complex transaction that valued the company at $21.7 billion. This means that Michael Dell and Silver Lake Partners more than doubled their investment in just 5 years, while also paying off most of the debt that they used to buy the company. That's a pretty impressive return, don't you think? The method Michael Dell and Silver Lake leveraged debt here is called LBO, or leveraged buyout. Using this method, a wealthy individual or a private equity firm buys a company using mostly borrowed money and then sells the company later for a profit. This way, they can acquire a large stake of the company with minimal risk and potentially huge returns. Number two, arbitrage strategy. Now, this may sound complex. I promise you it is not. Arbitrage is simply when they borrow money at a low interest rate and then invest it in something that generates a higher return, like high-yielding assets such as stocks, bonds, real estate, or businesses. Warren Buffett is a great example of a master at using this method. Buffett is a legendary investor and one of the richest people in the world. In 2016, he revealed that his company, Berkshire Hathaway, had borrowed $16 billion at an average interest rate of 1.8% and then invested it in various assets that generated an average return of 12%. That means that he made a profit of 10.2% on the borrowed money, which accounts for $1.6 billion per year. Apart from borrowing money at low interest rates to make profits through stocks, there's also another way debt is used to build wealth in the stock market, and that is, number 3, margin investing. Before we dive into the details, let's first understand what margin investing is and how it works in simple terms. In margin investing, you borrow money from brokers to buy more stocks than you can afford with your own cash. Let's say you have $10,000 in your brokerage account, and you want to buy 100 shares of stock that costs $100 per share. You can use your own cash to buy the 100 shares and pay $10,000 to the broker. This is called a cash account. But let's say you want to buy more shares because you're confident that the stock price will go up. You can use margin investing to borrow money from the broker and buy more shares with the borrowed money. This is called a margin account. Let's say the broker allows you to borrow up to 50% of the value of the stocks that you buy. This means that for every $1 that you invest, the broker will lend you another $1. This is called the margin ratio or the leverage ratio. The higher the margin ratio, the more money you can borrow and the more stocks you can buy. So in this case, you can use your $10,000 to buy 100 shares and borrow another $10,000 from the broker to buy another 100 shares. This means you can buy 200 shares in total and pay $20,000 to the broker. This also means that you have a margin ratio of 50% or a leverage ratio of 2 to 1. Now let's see what happens if the stock price goes up or down. If the stock price goes up by 10% from $100 to $110, your 200 shares will be worth $22,000. This means that you have made a profit of $2,000 or 10% of your total investment. But remember, you only invested $10,000 of your own money and borrowed another $10,000 from the broker. This means that you have made a profit of $2,000 or 20% of your own money. This is the power of margin investing. It allows you to amplify your gains by borrowing money. But what if the stock price goes down by 10% from $100 to $90? Your 200 shares will be worth $18,000. This means that you have lost $2,000 or 10% of your total investment. But remember, you only invested $10,000 of your own money and borrowed another $10,000 from the broker. This means that you have lost $2,000 or 20% of your own money. This is the danger of margin investing. It also allows you to amplify your losses by borrowing money. Using margin investing as a method of leveraging debt means you can increase your buying power and your potential returns, but also your potential loss and your risk. Debt in every form can make you rich, but also bankrupt. It all depends on how you use it and how much money you borrow. But how do you know if you're using debt wisely and responsibly? How do you know if you're using good debt or bad debt? Well, there are some general guidelines that can help you make smart decisions about debt. Have a clear purpose and a plan for using debt. You should only borrow money for things that can increase your income in the long run. Avoid borrowing money for things such as consumer goods, vacation, or gambling, which can decrease your income. You should also have a realistic and detailed budget that shows you how much money you need, how much money you can make, and how much money you can pay back. Always compare the cost of the debt and the return on the debt. You should avoid borrowing money if the cost of the debt is higher than the return on the debt, or if there is no return on debt at all. You also need to make sure you borrow money for the shortest period possible to minimize the interest payments. Always manage your debt and your cash flow. Only borrow money that you can afford to pay back without compromising your other financial obligations and goals. Late fees and penalties can damage your credit card. This is why it is important to monitor your debt and your cash flow regularly so that you can adjust your budget or your payments accordingly. Well, folks, that's all for today's episode of Fun Financial Insights. Debt is money that you borrow for someone else with the promise to pay it back later, usually with interest. Debt can be good or bad depending on how you use it and how you control it. Billionaires use it to build wealth, and you can too. I hope you found this episode informative and entertaining. If you did, don't forget to leave a thumbs up, and you can also share what you learned on your questions and feedbacks in the comment section below. And don't forget to subscribe to our channel and click the bell icon to stay updated on all future episodes. Thank you for watching, and see you next time on Fun Financial Insights.